Welcome back to the channel. Today we're going to dig deep into something that's been quietly evolving in the ETF space, SCHD, the Schwab U.S. Dividend Equity ETF. Now, this isn't about hype, speculation, or panic selling. This is about understanding what's happening behind the scenes, how SCHD has been performing, and what might lie ahead in 2026. So, if you've ever wondered whether SCHD is still the set it and forget it ETF it's been known for, or if recent market shifts mean you should rethink your strategy, stick around. We're going to break it all down in detail. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with a quick refresher. SCHD has long been recognized as one of the most reliable dividend ETFs out there. For years, investors have counted on it for steady income, low drama, and a portfolio of fundamentally strong companies. It's a value-focused ETF, meaning it prioritizes companies that are financially solid, with consistent earnings and a track record of paying dividends. For long-term investors, SCHD has been a dream. It doesn't chase the flashiest growth stocks, and it doesn't try to time the market. Instead, it focuses on businesses with proven strength, companies that pay dividends consistently, maintain strong cash flows, and have manageable debt. In short, it's been built to last, offering investors a predictable, income-generating investment. But 2026 has been different. This year, SCHD has been performing at a level that even surprised seasoned investors. It's not just keeping pace with the S&P 500, it's outperforming it, and in some cases, beating multiple benchmarks across the market. Part of the reason for this surge is something called reconstitution. For those who aren't familiar, reconstitution is essentially when the ETF reshuffles its holdings to reflect changes in the underlying index. SCHD's index is the Dow Jones U.S. Dividend 100, which uses strict rule-based criteria to decide which companies make the cut. The ETF also rebalances every quarter. So, while there's a big annual reconstitution in March, there are smaller adjustments throughout the year. This means SCHD is constantly being fine-tuned based on performance, valuation, and dividend metrics. So how does SCHD decide which companies to hold? Well, the rules are pretty clear and quite strict. The ETF looks at companies that have at least 10 years of dividend payments, strong cash flow relative to debt, and a high return on equity. Essentially, these are the companies that have demonstrated long-term resilience and financial strength. On paper, this is exactly what a long-term investor would want. But here's where things get tricky. The same rules that make SCHD reliable can also force it to sell off some of its best-performing companies. Here's how it works. If a stock in SCHD grows too quickly in price, its dividend yield might fall below the ETF's criteria. Even if the company itself is thriving and making tons of money, it could be removed simply because its price appreciation outpaced the dividend. This brings us to the key trade-off in 2026. Investors are seeing impressive performance from SCHD, but there's a risk that the ETF could start offloading some of its top performers. That might sound alarming, but it's not necessarily a reflection of poor business fundamentals. It's purely a rules-based decision. At the same time, SCHD may add companies that currently offer higher yields because their stock prices have dipped. Essentially, the ETF is adjusting its holdings to maintain its dividend-focused strategy, but this can create short-term volatility or shakeups for investors. For those holding SCHD, this adjustment period may last throughout the next 12 months. Understanding that dividends come from real business earnings, cash flow, profitability, and long-term strength is crucial here. SCHD doesn't pay dividends because a stock feels good or because there's hype. Every dividend comes from solid underlying business fundamentals. This raises an important question. What's your goal with SCHD? Are you looking primarily for quality businesses, or are you chasing higher yields? SCHD is designed for investors who prioritize stability and long-term growth through reliable dividend payments. But if your focus is on higher yields or aggressive growth, there are other ETFs like QQQ or other dividend-focused funds that might align more closely with that strategy. It's all about knowing what you want. SCHD's strength lies in combining reliable dividend income with strong, long-term business fundamentals. But chasing yield can sometimes mean sacrificing the very companies that have historically driven performance. Another factor to consider is sector concentration. SCHD tends to have heavy exposure to financials, industrials, and consumer staples. These sectors have been the backbone of its performance. Energy exposure is also notable in certain periods. However, one sector that's largely missing is technology. This is significant because it explains why SCHD hasn't mirrored the explosive growth we've seen in tech-heavy indexes like the Nasdaq. This isn't a flaw, it's intentional. SCHD isn't designed to compete with a tech-focused ETF like QQQ, nor is it meant to track the total market like VOO. Its goal is stability, income, and long-term value, not chasing the next tech breakout. Looking ahead, the key takeaway is that SCHD is evolving. The 2026 performance is impressive, but investors need to be aware of the ETF's mechanics, particularly the reconstitution and quarterly rebalancing. These processes may force adjustments in your portfolio that don't necessarily reflect the health of individual companies. They simply reflect the ETF's rules-based structure. Investors should also think carefully about their investment goals. Are you in this for steady income, long-term stability, or are you looking for aggressive growth and higher yield? Understanding what SCHD is designed to do and what it isn't is essential to managing expectations. For those holding SCHD, there are a few strategies to consider. Stay the course. If your goal is long-term, reliable dividend income, SCHD still fits the bill. Short-term adjustments shouldn't distract from its proven track record. Diversify. If you want exposure to sectors that SCHD underweights, like technology, consider complementing your holdings with other ETFs or individual stocks. Monitor reconstitution. Pay attention to the March reshuffling and quarterly rebalancing. Knowing which companies might be added or removed can help you anticipate changes in yield and sector allocation. Align with goals. Always check if your investment aligns with your objectives. SCHD is not for chasing short-term spikes or trying to beat growth-focused funds. It's about sustainable income and value. So, to wrap things up, SCHD remains one of the most reliable dividend ETFs on the market. Its rules-based approach ensures that only financially strong dividend-paying companies are included, but that also means top performers can be rotated out if their yield falls below the ETF's standards. In 2026, we're seeing exceptional performance, but investors need to understand the mechanics behind the scenes. Reconstitution, quarterly rebalancing, sector concentration, and the balance between growth and yield all play a critical role in how SCHD behaves. Ultimately, the question isn't whether SCHD is performing, it's whether it fits your goals. If you're looking for long-term income and stability from high-quality companies, SCHD still delivers. If your focus is chasing yield or rapid growth, other options may be more appropriate. Investing in SCHD is about understanding the rules, knowing what you want, and having patience for long-term results. And remember, dividends don't come from hype. They come from strong, enduring businesses that can sustain growth year after year. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.